Okay, today we're going to break down a really straightforward trading strategy you can use right at the 9:30 a.m. market open. But here's the thing. The real story isn't just the setup, it's the data. We're going to dig into a 300-trade backtest that reveals something pretty shocking about what it actually takes to be profitable. And spoiler alert, it involves losing way more often than you win.
I mean, how many of you does this quote from Craig Prococo just hit home for? That feeling of spinning your wheels, right? You're trying all these different complex strategies. You're just burning time, burning money. It's an incredibly frustrating journey, and it's the exact trap we're going to learn how to get out of today.
So let's dive right into this idea of the trader's trap. Why do so many people who get into trading just get stuck? Well, it usually comes down to a handful of common mistakes that just kill any chance of making real, consistent progress.
And you can see how these all feed into each other, right? They create this vicious cycle. If your strategy is based on emotions, it's never going to be consistent. And if you're not consistent, you have absolutely no way of knowing if you have a real statistical edge. So what do people do? They overcomplicate things, slap a million indicators on their chart, or get spooked and take a tiny profit, completely wrecking any edge they might have had.
This, right here, this just nails it. Most traders are living on the left side of this chart. It's a chaotic mess of complicated ideas, emotional decisions, and just random actions. The goal, the whole point, is to get to the right side, to a philosophy that's simple, repeatable, and driven entirely by data, not your gut feeling that day.
So the big question is, how do we make that jump? How do we get from chaos to clarity? Well, it all starts with a philosophy of simplicity. Before we even pull up a chart or think about an entry, we need a solid blueprint for how we're going to approach the market every single time.
And this blueprint is built on these three pillars. Number one, simple. If a strategy is so complex that you second-guess it or it only shows up once a month, it's useless. It's got to be simple. Number two, repeatable. You need a mechanical process that you can execute flawlessly, especially when the market is flying and the pressure is on. And finally, number three, measurable. You have to track your results so you can know with cold, hard data that you have a genuine edge over time.
Okay, so with that philosophy locked in, let's get to the fun part, the actual strategy. This thing is designed specifically for that 9:30 a.m. New York open. Why then? Because that's typically when we see the most volume and the most participation. And that chaos creates some really clear opportunities if you know what to look for.
First thing we need to know is a change of character, or COCH for short. Seriously, just think of it as the market hitting the brakes and signaling a potential U-turn. So imagine a stock is just falling, right? Lower lows, lower highs. Then all of a sudden, bam, it breaks that pattern and makes a higher high. That's it. That's our change of character. It's a little signal that the old trend might be over.
The second key piece of this puzzle is the fair value gap, or FVG. Now this is our entry signal. It's a very specific three-candle pattern that shows up when the price moves so fast that it kind of leaves an imbalance, a void behind. You can think of it as a pocket of air that the market almost always wants to come back and fill later. And that gives us a super predictable zone to plan our trade around. So let's put it all together. Here's the 5-step checklist. 1. Before the market even opens, you just mark your key price levels. 2. After 9:30, you sit on your hands and you wait for that change of character. 3. Once the structure breaks, you find the first clear fair value gap that forms. 4. And this is so important, you do not chase the price. You patiently wait for it to pull back to the middle of that gap. That's your entry. And finally, 5, you set your trade. A tight stop loss just outside the gap, and here's the magic, you aim for a profit target that is at least 4 times bigger than what you're risking. Simple, repeatable, measurable.
Now, I know what you're thinking. That sounds great in theory. It's a clean, mechanical process. But the only question that matters is, does a simple strategy like this actually work over the long haul? Well, let's look at the data from a 300-trade backtest.
I mean, this is the million-dollar question, right? We've tossed out all the complexity, we've ignored all the fancy indicators, we're just relying on a simple, rules-based system. So, what kind of results does that actually get you?
36%. Just let that sink in for a second. Out of 303 trades, this strategy was a loser almost 2/3 of the time. Now, everything you've ever been taught about trading says that sounds terrible, doesn't it? Most people would see this number and immediately say the strategy is a complete failure. But that's because they're missing the single most important piece of the entire puzzle. And this chart right here is the whole secret. This is why that 36% win rate doesn't just work. It's actually incredibly profitable.
See, the key to this game isn't how often you win, it's how much you win when you're right versus how little you lose when you're wrong. Because our average winning trade is 4 times bigger than our average losing trade, you can lose and lose and lose again, and still come out way, way ahead.
So let's just put a bow on this data. Over more than 300 trades, yeah, you're going to lose way more often than you win. But because your winners are so much bigger than your losers, all thanks to that strict 1-to-4 risk-to-reward rule, the system makes money. That is the definition of a statistical edge. It proves that a profitable system has nothing to do with being right all the time.
And that really brings us to the final idea here. This whole thing wasn't just about one specific 9:30 a.m. strategy. It's about a total shift in philosophy. It forces us to ask, is that endless hunt for a perfect strategy with a 90% win rate just a giant distraction? Or is the real secret just having a simple, repeatable process with a proven statistical edge that you can actually execute day in and day out? What do you think really matters more?